Volatility this week is raising a lot of anxiety about stocks, as all of you know. Nearly 20% of the S&P 500 already in bear market. But this may also be the best time to pick up some names at a discount. So with us today to help us do that, Chad Morganlander, portfolio manager at Washington Crossing Advisors, and fast money trader guy Adami. And we want to kick it off with Vic on Twitter, who asks, is Goldman Sachs broken or a buying opportunity now? Let's go through it.
Well,
guy.
Is it broken? The market's broken, so by definition, Goldman Sachs is broken. Stocks have become a collateral damage of everything you just talked about in terms of volatility, but you got to break it down and try to take emotion out of it. Goldman just reported their quarter. They said book value for the company was $181 a share. What does that mean? I think the right price to book for banks in this environment is about 1.7, 1.8. What does that mean? Well, it gets you to about a $320 stock. Is it happening today? Clearly not. I mean, but you try to take emotion out of this equation. And then ask yourself this. You know, the trading environment that we find ourselves in, that should actually work to Goldman's benefit. So although this is extraordinarily painful, I do think if you start to look at Goldman here, it's going to be pretty interesting in the months to come.
You think they're happy over there with a little volatility for the first time in 1,000 years?
Well, it all depends if this starts to leak into the credit markets. If it does leak into the credit markets, then they can be vulnerable for that matter. So as a trader, if you're looking from a trading perspective, we would be fading this trade or not be in it at all. When it comes to a long-term investor perspective of 3 to 5 years out, then I totally agree.
So you said something, Guy, there.
What did I say, Ty?
You said broken market.
Yeah, it's broken.
And when people hear that, who don't understand the market as well as maybe you do, I can imagine that makes them anxious. I don't want to be in a broken market. What's broken?
Well, I'll tell you exactly what's broken. You just talked about it before. The market was up at its peak today, a couple 300 points. Now you see where it is today. Do you think that's a sign of a healthy market? No, it's a sign of a broken market. Why?
What's broken?
Because 7 years of hubris and complacency are manifesting themselves over the last week. And I've said this, and listen, I'm no fan of the Fed. I put that out there ahead of time. So come at me if you want. But one of the many consequences of our Fed, which has been too accommodative, is it's taken volatility out of the market. People are like, wait a second, why do I need to buy volatility now? I don't need to buy it. And then over the last year, people said, wait a second, I could actually make a synthetic dividend by selling volatility. Where do I sign up for that? Whether the Fed realized that was going to happen or not, it has happened, and it's at their feet. Now, you could say, well, wait a second, Guy, they bailed us out. Yes, but I'm telling you, for every history is littered with devastating consequences born of good intentions.
It's like a spring. They pushed the spring all the way in with rates so low for so long. And now, because of interest rates and prospects of the Fed raising rates and a whole bunch of other stuff, that spring is uncoiling itself.
But it also pushes people to places in the market. It also pushes people to places in the market they never would have gone, right? With a double inverse on the VIX.
Yep. All right. Glenda writes to us today: is Amazon a good buy for 2018? Chad, you first.
So we'd shy away from Amazon. Our better investment that we think on the consumer staple and consumer side would be Walmart. We think that Amazon, although, okay, it's going to sell into and sell everything, it's still, from a valuation perspective, we think it's incredibly lofty.
And that's been a knock, obviously, on Amazon for the last...
Always will be.
Always will be. But look at the last quarter and take a look at what they did. Forget about all the numbers. The one number that stuck out to me, operating margins were supposed to be, I think, 2.2%. Operating margins came in at close to 3.5%. That is a staggering number for that company. What's the point? I do believe that Amazon, anytime they want, can sort of turn that dial on the margins, and you saw it last quarter. So will it be good for 2018? There's some more pain here. Clearly, names like this are going to be sold off, I believe, quicker than some of the other names. But if you have the temerity to get in and say, you know what, Amazon isn't broken, the market's broken, it is going to be interesting.
It depends
for 2018.
what your rules are as an investor. If you're a value investor, you're never going to look at Amazon and say, I like what this stock is doing. I know their business is rip-roaring. They're putting people on the defensive by the week.
I'm a low beta manager, our group, so we're going to shy away from those growthy type of names. Yeah. And in this type of market environment, as you start to see the Fed and the ECB start to move, we think the low beta names are going to outperform.
It's important to remind people that the bigger the multiple on a stock, the more susceptible it is when interest rates rise. 100%. Because you look, if you have to go out way too far in the future to find those earnings, there's so much uncertainty there, you just buy a treasury with a higher yield.
All right, let's talk to Frank. Frank says, Snap has been low for a while. Is this stock a hold right here? Guy,
Well, I don't believe in holds. I think if you hold something, it's the same as buying something. Karen Finerman says this all the time. If you go home long a stock, you might as well have bought it because you're long it at the price that it closed. I'm not trying to get too wonky, so forget about the whole thing. I do think Snap has some upside, and Dan Nathan has talked about this. I understand that this company, the first couple conference calls were a train wreck. Mr. Spiegel could not have been worse. Last conference call, I think he did a good job. And I'm not comparing Snap to Facebook, but it took Facebook a long time to get on solid footing. And I believe that's sort of what Snap is doing
Let me
now.
take the liberty of rephrasing the question then a little bit, since this gentleman's not with us right now. The stock had traded sideways for all intents and purposes. It had some moves here and there. But the spike most recently, if I own it already, should I sell it? Should I sell it?
Well, then we're making a market call. But so
I'm just saying, but the stock
I don't
popped
think so.
much.
I'm going to tell you, I would say you stay with this thing. I would actually look to add to this company. Now, there are certain companies that I think have turned the corner.
Doesn't this take up like 25, 30%
I know
the
it
other
is,
day?
and I understand listen, the trader in me says you have to take some money off the table. And the best thing to do is take half off, give yourself, don't let the market trade you, trade the market, if that makes sense. But I submit that this stock has some more room to the upside.
You remember what you mentioned Facebook there, and remember 5, 6, 7 years ago, whenever it was, everybody was worried about Facebook. They don't have a mobile strategy. They don't have a mobile strategy. They're not there. They're not there. They're not there. Then they got a mobile strategy.
Very quickly got there.
And they got there. And you can see what happened with the stock.
And I think that's what's sort of happening here.
All right, Vic says, is UPS a buy? Chad, you get this first. And of course, there's this news about Amazon getting into its own distribution and shipping.
Right, this one I'd sharpen my pencil on, because from a value perspective, it's starting to look quite attractive. Now, of course, in the long run, if Amazon does get into the business, that's going to put some pricing pressure on UPS. But nonetheless, we think that in a growing global economy of which we're in, and we will be in, we think that UPS will do quite well.
All right, finally, Nancy wants to know. I guess she's home today. How does tax reform affect company valuations and earnings estimates, Guy?
Well, valuations, I mean, if you think about it, you want to take a great example of that? Look at what happened with Boeing. When the tax reform thing came down, look at exactly what happened to Boeing, the company. They talked about it being, I want to say close to 14, I forget what the percentage points were, but it was ridiculously accretive to their earnings power, and it obviously took their multiple down. Look at the guidance raise they made last quarter. They went from $11.50 a share to $13.50, largely in part to everything you discussed there. So it's obviously very accretive. The question you have to ask yourself back is it all priced into these stocks? And I would submit 85 to 90% yes.
I agree with Guy. Priced into stocks on the S&P 500.
I agree with Guy.
Chad,
We have a quorum.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.